Okay, good afternoon. Welcome to the weekly Take on the Market. Today is Friday, April 7th. The market's been closed all day for Good Friday. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody that I'm aware of at IBD is licensed. We don't make buy, sell, hold recommendations. Okay, thank you. So the agenda is typical, the same. Market thoughts, industry groups, stocks to watch, quote of the week. I don't have a whole lot for the industry groups. Do have a handful of stocks that are interesting that we can talk about. And then market thoughts, we'll start there. So somebody asked about the seasonality chart, and here we are. Ideally, we're in a sweet spot seasonality. Seasonality works, I think, but it's not, it's on the totem pole of 20 items. It's, it's in the bottom quartile for me. I would never make a whole portfolio decision based on seasonality, but I have mentioned the O'Neill portfolio managers do a lot better in the fourth quarter based on, years and years of study of their performance. And this chart shows you that as well. So there is something to it. Ideally, we're in that spot where the market will, trend higher. Sentiment is pretty negative, although it's improving. So you can see here, we still have more bears than bulls, but not quite like what it used to be a handful of weeks ago. And sentiment's very interesting to me. There are periods of sentiment works really well, and then there's periods where, it doesn't work well. There's a lot of reasons to be negative right now. You got the debt ceiling, the banking crisis, the war in Europe, inflation, the Fed. I could go on and on and on. So there's a lot of reasons to be bearish, but in the end, the market's constantly discounting that information. So if it's probably mostly in the price already, which is why I think the price is, most important. Price is what pays. Yeah. So I spent most of my energy is going to be on, am I able to make progress? Is my account going up? To me, that's the most important when I'm thinking about overall portfolio position. But I do look at sentiment. I do like to be positioned, not a total contrarian, but a tiny bit contrarian. I'll talk about it like with on. To me, on coming off this short stroke was just too obvious and was prone to failure. And we'll talk about that with the stock. So I don't like situations where there's too many eyeballs on the market. And then when the headlines are crisis, 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 then, I think maybe the market can go up, especially if the market's not making lower lows on all this talk. Here's a nice chart of it. And you can see in the 07 to 09 period, sentiment stayed the spread between, this is from Bespoke. I want to give credit where credit is due. The spread between negative and positive has stayed for a long, long time. And maybe we're in one of those periods. You can see like we've got a lot of red for a while. And it's usually in bear markets because there's the markets are down and they're staying down, and there's a lot of reasons to be negative. All right, before we jump into the industry groups, let's look at the indexes. So here's the NASDAQ, and it just doesn't look all that bearish to me. You could argue this is like a little cup with handle right here. Maybe we can get above there, or you could even argue that it's a much larger cup with handle. So it just doesn't look all that bearish. The S&P looks okay, not as good as the NASDAQ. The Russell doesn't look good at all. It looks a little bearish, and that's where all the the regional banks are located, which is why it's done poorly. And then I'll just use the diamond, the Dow. Looks okay, not as good as the NASDAQ, but very similar to the S&P. So I'm I don't love the market. I don't hate the market. It just is what it is. Just here. I have, and I've said it 1,000 times, I just don't put as much weight on the overall market that I might once have when I first started out. I just think look, it's super concentrated. I might have mentioned this either on IBD or on my video, but I think it was on IBD Live, where the top 15 stocks, this was a few weeks ago, had gained $1.8 trillion this year. The rest of the S&P 500, so the top 15, 1.8 trillion, the rest minus 21 billion, which is basically negligent, which is zero. So all of the performance in the S&P is in the top 15 stocks. And we've seen it in the NASDAQ with Apple and Microsoft. I think Apple and Microsoft make up the largest percentage of the S&P in history, going back to when IBM and AT&T dominated. So, it's not really that great an index. It's all it is what's Apple doing and what's Microsoft doing. Look how very similar these charts look. I mean, they look almost identical. So you have a low, a higher low, and look at Apple. A lower low that time, but now a higher low. And Apple is 10% above the 40-week moving average. Let's see what Microsoft is. Microsoft is 14% above it. And NVIDIA and Tesla and Google, they stir the drink a little bit too. But the indexes are they're just these big companies, and they just don't tell the best story anymore. They're not as diverse as they used to. Now, let's look at a monthly chart. And you see, I was listening to a podcast. They were talking about a certain number of days, where, the market stays down and never makes a new low. And I think they were talking about the S&P, but you can see the NASDAQ just like a record before it made a new low. Now the S&P, before it made a new high. It made a nominal high right there, much sooner in 2007, where the NASDAQ in 2007 did not. Look at that. I don't really have to admit, I didn't realize that right before the great financial crisis, the NASDAQ was still 50% off of its highs. And then you have this higher low there, and the S&P actually made a lower low, right? Interesting. Well, partly because it didn't correct as much, and partly because of the components. The type of damage in the great financial crisis was related to banking and brokerage firms and housing, more specific to the S&P, whereas the 2000 bubble was tech stocks. And that's why, they're so different. So you've got a long period of before it's made a higher high. That's not too bad, but remember, these are monthly charts. And it looks like we're in one of those periods. So it could be a while, I think. And, I don't know if it's worth anything, but I'll just tell you because that's what I'm here for. I think market stays in this range for a long, long time. What's a long, long time? 18 months, 5 years? Sure, possible. But in that time frame, you could have some really good stocks to own. So from this low, 1013 to now, so in this time period, the S&P has made a little bit of progress, but let's look at like ALGM. Where's October? All right, how's that for progress? Now, you're not going to buy the low, but it's almost it's up 2.5-fold in that time frame. How about ACLS? 50 to almost tripled. How about NVIDIA? Is that the low? Yeah. And so that's 110 to 280. So you get the idea. There's always opportunities out there, always. You just have to find and dig a little bit, and you don't have to own that many stocks. How many stocks do you need to own? So if you own these three, then you'd be golden in that period. So that's what I think is going to happen. I think you need to focus more on what the stocks you're doing, the stocks you buy, And most important to me is, can I get the stocks I own to go up? And then step two, if they go up, can they stay up? Because that's not always easy as well. And then step three is get, a significant position in them enough that I can handle it correctly. So I think the market is what it is. It's possible we never see this low for a long time, if ever. It's possible we don't see the high there for a long time. Although I would, if you put a gun, if you force me to choose, I think someday we'll take out this high. That's just the way the markets have done. And, someday we might not take out this low. It's possible if you look at, this low on the NASDAQ. It's never seen that or that low, although we did take out that low. I don't have to put my chips down and make a bet based on that. So in the here and now, I think the market's just okay. I have some longs, I have some shorts, but the other nice thing is you're getting paid finally for the first time in forever to sit. So the 10-year is yielding, 4% or something like that. I think I have I don't have any 10 years, but I have all, short-term 12 months or shorter. They're all almost 5%. Short-term rates are, maybe that's 0 FNX. But anyways, you're getting paid to sit. Before, go to a monthly, there just was no yield. There just was nothing. So you can, make 5%. It's not great, but you can make 5% on half your portfolio. And then if you can make 20% on the other half, being in stocks, you have very little risk and you net out a pretty good return for the year. I think that's kind of how I've been playing it so far. And I can't remember if I've ever been fully invested in my cash account in stocks, fully invested in stocks this year. Okay, so let's go back to the slide. Pause. And that's just a reminder for me so I don't mess it up, because I messed it up before. So we'll do industry groups, some stocks to watch, and then we'll do the quotes. So resume share, Scott, don't mess that up. Industry groups. Not a whole lot here. I looked at this earlier before I started this. Leisure travel booking, that's like Priceline/booking. Metal product distributor, 2 little stocks to make a difference. Electronic fabless, this is a great group. A lot of stocks, quality merchandise, earning sales, stuff to buy here. So I've talked about semis many, many times. Computer hardware, peripheral, let's bring this up. Telecom equipment, computer, education, mining, gold, silvers, AGI, and OR have been pretty good, but there's some others that are setting up. Gold is kind of hit or miss. Gold's tough, but it looks like it's possibly coming out of a really long base. Semiconductor equipment, so like ASML looks pretty good. Leisure, that's almost always Netflix. Shoes, that's ONON and Crocs, etc. So it's pretty diverse, but I like the fact that there's a couple of groups that are viable, that have growthy type names in there that you can, explore. Stocks to watch. Let's start with ONON. I know there's a ton of eyeballs on that one, and I'm going to turn my camera off so you can see the chart better. And, this is the most visible short stroke in short stroke history. Now, short strokes don't happen that often, but it just was all over Twitter. And so I just be honest with you, I don't want to say I knew it was going to fail, but I knew it was going to fail. At least I thought it would. So it, tried to break out, and then gap down. I think maybe there was a catalyst to a downgrade. So if you're interested in ONON and you don't own it, now you've got, a better entry. And I'm not talking about the price. I'm talking about the fact that it's had a shakeout. Because see, when it comes out here at this point, there's been no shakeout. It's just been too easy to hold. And we know that that's not always the case. So it goes from 25 to 33 with very little pullback. It's just not sustainable, I don't think. I'm always thinking, where's the shakeout? That's why I like to buy stocks after they shake out. Those are my favorite. So you've had the shakeout. Now, is this enough? I don't know. I don't own ONON. I'm not in any rush to get into it, but no, a lot of people like it. A lot of people have eyeballs on it. So I like the entry better here than I did, 2 or 3 days ago, because you've had the shakeout. SCCO, which is, one that I owned on, this shakeout on the undercut. Let me turn the pattern rack on. And, it just kind of epitomizes how tough the market can be. So, maybe I'm a little greedy, but it goes from 70 to 77. And then it gives back roughly half of the move. There's nothing wrong with that per se, but the problem is it gives back half. And then if it does that again, I've given back my whole gain. And so when they do this, they have these bad days. I just slowly peel out of them. So I don't own this one anymore, but I'm willing to go back to it. But it's just a lot how the market is. It's the market's 3 steps forward, 2 steps back, or 4 steps forward, 2.5 steps back. It's just kind of difficult. So that's why I tend to sell them on the way up. Problem is, you do that, and then you sell an ALGM or you sell an ACLS, which I showed earlier, and you miss those. So, but I can show you that TNK, sell on the way up, avoid all this. TRMD, sell on the way up, avoid all this. What else did that? TNP, sell on the way up, avoid all that. So you take the good with the bad. I think you want some consistency. Either you do it all the time. So I sell ALGM on the way up. I don't remember where. And then I miss further gains, but I also miss these ones. Or you just keep them all and, ALGM, and you've got a big winner. And, TNPs and those ones of the world, you have to, give back all your gains, which is pretty frustrating. I find that's emotionally a little more difficult for me, which is why I tend to sell. Now, I think there's a sweet spot in the middle. For every 10 stocks that you sell for a profit, I think you should keep 1 or 2 and try to capture a big move. I think that's my thought process. So maybe I'll get lucky with 1 if I keep 2 of them, and maybe 1 of them I keep will give it all back, but the one I don't keep, or the one I choose to keep, keeps going and going. That's kind of the perfect setup. I know it's not going to happen like that all the time, but it only has to happen once in a while, catch a really big winner. ELF, it's been really, really big winner, but again, this is perfect. Here's the, the obvious pivot right there, and failed. Now, I should have buyer there, buyer there, buyer there. Now, I know that you're going to earnings, but if you're ever going to have a big winner, you're going to have to sit through earnings. Maybe you don't have a full position. Maybe you have a half or a quarter position, but you can't avoid earnings. I just don't know any way to play this game the proper way and avoid earnings completely. You're just not going to be able to get enough juice. You're going to have to be in for earnings. And you know what? Sometimes you're wrong. Sometimes you're right. If you're wrong, hopefully it's not you're not wrong huge. And if you're right, you can be right huge, like ELF was. So that's kind of how, if I go to, let's say I buy, and let's backdate this, because somebody was asking about like position sizing. So now this is with the benefit of hindsight. So keep that in mind. But this is good enough. So if I buy ELF there, let's say I want 1,000 shares, I might buy 300 or 400. That's usually kind of how I do it. And then that way, when it shakes out, it doesn't hurt so much. If I buy 1,000 there, I'm probably going to get shaken out. So I buy 300 or 400, and then I'll buy 600 here. And then I might buy 100 there. And then I might buy 100 there. And then I might buy 100 there. That's how I will do it. And then now I might be up to, let's say, 1,400 shares. And now the size is enough that, and the move is enough that the profit is kind of burning my hole apart in my pocket. So I might sell 400 shares. So I'm down to 1,000, right? And then you get this, I might sell 300 shares. So now I'm down to 700. And then what happens is I miss this kind of, rest of the move, but that's okay. Still have a little bit. And then it goes sideways. And it builds kind of this, and then this is kind of the eyeball test, whether it's IBD Live, whether it's Twitter, whether it's emails to us, whether it's friends that trade. I just kind of have this spidey sense about the eyeballs, and I don't, and then it's too many eyeballs and I get nervous. So this is a bull market breakout. In a bull market, this will work. In a bear market or a choppy market, it's not going to work. Too many eyeballs, too short a base. This is breaking out of a nothing is kind of what Bill would call that. So when it starts to go down, I might be a seller again. No, maybe I might sell 200 shares. Now I'm down to 200. If you buy like that, let's say you buy 1,000 and 200 and 200, that's fine. It can work. You can really pressure winners and you catch one, it could be great, but you really got to be spot on. Like when you get this type of action, you really want to sell this 200. In fact, you probably want to sell that 200 as well. And next day, now you might want to sell this 200. And then the next day, you might want to sell this 200 and so on. And so that's kind of how I would do that. And look, you're going to have like 12 or 13 trades on a single name, but in this day and age of zero commissions, I don't worry about that. I'd rather, handle the stock correctly, worry about the commissions and taxes, forget about it. I'd love to have big tax problems again. Let me tell you, in 25 years, I've had some tremendous tax problems in some years, and I've had some years where I didn't have any tax problem at all because I didn't make any money, I lost money. And I prefer the years where I have the tax problems. Now, I also think you probably want to have, I'm not licensed, I'm just going to tell you based on my experience. Let me tell you a little story. You want to have some tax-free accounts. IRA, Coverdale's for your kids, Roth IRA. The Roth IRA is fantastic. I just think it's the greatest thing since the wheel. My daughter has a job. She's almost 18, and we just went down to Fidelity and opened a Roth IRA for her. I'm trying to explain to her the process. You put in a little money now. It's hard to see the forest through the trees, but imagine from you get the calculator out, you just make 8% a year or something like that, even 5% a year. And the compounding is tremendous. So that's my little soapbox moment. Get yourself, especially if you're young, something tax-free. I've got a lot of tax-free accounts. I've got one of everything. I've got Roth. My wife has Roth. I've got Coverdale's for my kids. I've got a traditional IRA. I've got a SEP IRA. My wife has a traditional IRA. I just, so as far as taxes, I get it. The compounding is much stronger, obviously, without the taxes. But in the margin account, there's just no way around it. So I pay the taxes gleefully. I would love to have those problems. So back to ELF, and maybe you're down to 400 shares. And honestly, I don't know if I would survive this type of break. Let's just say I'm not in there. But now the stock, what should the stock have done? Like that was a huge volume break right there, right? What should the stock do? It should go lower. It did for a day or a day and a half. And this doesn't have to go lower exactly, but every day it stays up and not making another lower low is telling you that that's a shakeout. I probably would buy another starter position right there, 200 shares. Let's say a normal position is 1,000. I might buy 200 there. Oh, I might buy another 200, get to 400. Or I might even buy another 400 and get to 600. I don't mind doing it that way. I know that's how Darvis would do it. Darvis would put these probing positions, and then the ones that would go up, he would actually add more because that was his standard size. And the nice thing about doing it that way versus the way that Bill teaches it is it's really easy to take a loss if the position is small. If I have 200 shares here and it just collapses and I get, 4 points on me, $800, it's psychologically easy to take that loss. If I have 1,000 shares, it collapses $4,000, psychologically tough to take the loss. So make it easy on yourself. I don't know. I like to. There's some guys out there that are super disciplined, like Mark Minervini and Bill O'Neill. That's one thing Scott would say about Bill is super disciplined. But I live in the real world. I have to admit that in moments of weakness, I lose that discipline sometimes. It's rare. It doesn't happen a lot, but it happens enough times that I'm aware of it. So I make it easy for myself. I'm not going to lose my discipline on a smaller position. Now, if I have 200 at 54 and I buy 400 at 56, I'm jamming my average cost. And I know that's what Bill would talk about being a hawk on your average cost. So I do understand there's downside to doing it that way. But again, now I know what my average cost is. And if I have to, I'll stop out on it. But at least I'm buying more on the way up. And then, I'm going to turn off the pattern rec so you can see this, but then I might get to a full position right there, right? It's a shakeout. It should have gone down and it didn't. Now, I think the next day, yes. Okay. So this is into earnings and I'm full position. So what does that mean? For me, a full beginning position, with a, 1 or 2 or 3% cushion is going to be about a 10% position. So do I want to hold that into earnings? A lot of it depends on how well I'm doing for the year. If I'm up on the year, I'm going to be more aggressive. I'm going to be willing to risk the points I've put on the board. What type of stock is it? Is it AEHR or is it Elf Beauty? AEHR, probably not. I think AEHR was pricing in like a 17% plus or minus on the earnings release. But Elf Beauty, I don't recall, and I did not do this trade. This is just more of a kind of position building exercise because a lot of people, it's a common question I get. I doubt Elf Beauty had that same kind of volatility priced in, so I might be able to hold that into earnings. And I like to hold into earnings because to have a big winner, you need to hold into earnings. So I take the good with the bad. Sometimes they gap up, sometimes they gap down. Hopefully you get more gap ups. Hopefully the gap ups are the magnitude much greater than the gap downs, and so on and so forth. And now you've got back to a strong position. And then as it's doing this, I'm probably going to be peeling off some into that. And if we fast forward to today, and look, I sold it and I avoid this. I know it's higher. Now I can always add back what I sold. A lot of times I won't, but I will sometimes. And the idea is not to sell it at 75 to buy it back cheaper. I'm just like to ring the cash register a little bit, like to take off some of the risk. It's become a larger position because its stocks moved. And, also maybe I want to move the money into another name where, I might think Elf has 5 points upside and 5 points downside. I might want to be in XYZ, which I think has 10 points upside and 3 points downside, something like that. All right. Google looks interesting to me, breaking out of this space right here. And, it's part of the whole, and I do own Google. It's part of the whole big cap where all the money is moving. And there's a couple of reasons. Well, it's breaking out of a base. One, it's a first stage base. Stock's been down a long time. Two, I know the earnings and sales aren't as good as I'd like, but it's Google. The brand is tremendous. And I've always felt like I should have a strategy for buying these tremendous brands when they pull back. So this is a 40-week moving average, this magenta line. And what if I bought Google there or here? Now, if I bought it there, I'd have got stopped out. Okay, that's fine. Or here, somewhere in there, I might have survived, but maybe didn't make any money. But I see this in some really great brands, MasterCard, and you can ignore that's a bad tick, but MasterCard here after the 08 crisis. Didn't quite get there, but look at that one right there in 2020, or Visa or Costco. So Costco there. Undercuts, maybe I buy it on the way back up. If I have 10 stocks and 9 of them are, go-go's, the AHRs of the world, the ALGMs, why can't I own a Costco or a MasterCard or something like a Google, like I do own, with this type of strategy? So, it's a bit of an experiment, but I think the risk reward is worthwhile. So I own Google and I am short like Tesla. So it's kind of easy to sleep at night being long Google and short Tesla. It's not tit for tat as far as volatility, but it's pretty close. Probably going to be hard if the NASDAQ's up huge for me to be down on Google and down on Tesla. They'll both be up, and the other way around. NASDAQ gets really bad, Google's going to go down, but hopefully Tesla goes down more. So that's kind of my thought process. And then 2, this whole AI thing. Now AI cratered. A short report caused this to happen, but AI is real. I was listening to Jason Thompson on IBD Live, and he was talking about AI and thought process, and I was, I was like, yeah, he's right. This is real. This isn't going away. Who's going to win the battle? Now, I don't know. I don't know who's going to win the battle, but I think Google's a pretty good company. They got a lot of resources, a lot of brain power. They've won the battle in other areas. So I think this is a good bet. I think the risk reward on something like this is really good. And fast forward, if I have some kind of patience, 6, 9, 12, 18 months could be significantly higher. So the risk reward is very little in that, low in that regard, I should say. Tesla, since I mentioned it, it did what I was hoping it would do as a short seller. It broke out and failed. Now it is down 4 days in a row. It's a little stretched. I don't have quite the position that I once had. But I don't know. I just think this stock's going lower. There's no right, wrong, and different. I just think it's going lower. All right. So are there any other stocks I wanted to cover? I think that's good. Let me look at my watch list here, and then we'll jump into the quote of the week. All right, and I have 2. So, and I want to say thank you to whoever knows. Oh gosh, I'm drawing a blank. I did his Jim Leitner. Whoever knows Jim Leitner, he was quote of the week, last week or 2 weeks ago, and he reached out to me on LinkedIn, which is very cool. And Jim Leitner is, I don't know, I think his story is really cool, and I think he's a great thinker. I like, and I mentioned previously, I like the way he thinks about the markets and all that, and he's, you can't argue with the success he's had. So, and he reached out to me on LinkedIn and said, "Hey, I heard you use my quote in your video," and I was like, "Uh-oh, I hope that's okay." Let me start my video back up. So whoever did that, that knows Jim, thank you. That was really cool. And he was really nice. And I'm hopefully I'll have him on. I'd like to have him on IBD podcast. I think he'd be a great guest. Or if I have to, maybe I'll have him on a video or something. I think that'd be cool too. Anyways, but thank you for that. So I'm now going to just start quoting Paul Tudor Jones and George Soros, and find hopefully some of you guys out there know these guys, and they'll reach out to me. So that was the first time that's ever happened to me. So I had a feeling someday that would happen. So, but obviously all the quotes of the week are very complimentary, and there's a reason that I use them, because they provide value. So anyways, all right. So this week's quote of the week, or 2 of them, we'll do 2. is from Mike Wilson. He's the strategist at Morgan Stanley. He was on a podcast, and I like this. It's amazing how consensus professional forecasters have become overly reliant on guidance. This is why stocks move so much on earnings. There's no dispersion in the forecast. So it's very difficult for somebody to kind of go out on the branch and say, oh, we think ELF's, let's say ELF is going to do 80 cents. They all congregate around 80 cents, give or take. You very rarely see a guy or a gal out there at 90 cents or a guy or gal down there at 70 cents. Which means that when something happens that's unexpected, price action is way worse. Talked about this a lot. This is why the earnings reports are so difficult, is because of this. So what's happened is the consensus earnings forecast dispersion is non-existent. So a guy much smarter than me, way up the food chain on Wall Street. This is, you're hearing it from his mouth on why, the earnings reports and other things like that create so much havoc when they come out. And then Brian Belsky he is a strategist, I believe, at BMO Capital Markets. I didn't know he worked at William O'Neill and Company. I just thought it was very cool. He was there way before I was. On the Tape podcast interview, comes back to one of my very first rules I learned in investing over 30 years ago. I worked at William O'Neill and Company, had the very good fortune of being in front of both Peter Lynch and Warren Buffett, and both of them said the same thing: only buy things you can reach out and touch. So I think the market comes and goes into periods like this, but I think it's 2017 where the market was only cared about sales growth, and SaaS software companies were killing it. Coupa Software and although Team had earnings, Team was a good one back then, and others. But right now, I feel like the market's in this period where you have things you can reach out and touch. And I think it's Dennis Gartman says things you can drop on your foot. And I like this a little better because, I like semiconductors because they're real. You can reach out and touch them. Copper stocks, possibly, maybe gold stocks. Who knows? I've been in and out of those. They're tough, but who knows? Oil and gas stocks, maybe something like that. So I have avoided the Shopifys and the Twilios of the world so far since the bear market started. Some of those companies will come back, but most of them won't. So around 3 or 4 of them will kind of fall off the radar and just wither and die. They won't go away, but they won't be leading stocks. 1 in 4 will come back and exhibit leadership again, but most of the time you're swimming upstream. Roughly 3 out of 4 fall by the wayside. So, all right, I appreciate it, you guys. Have a great Easter weekend. MarketSmith and Investors.com, 800-424-9033. Here's our Twitter handles. I don't tweet very much, but the MarketSmith account, a lot of times I'm tweeting under the MarketSmith account, the historical stocks of the day, things like that. So if you wish to follow us there. Have a great weekend, everybody. Thank you very much. Bye-bye.